I get asked about investing in Costco, ticker COST, as an inflation hedge a lot. And it makes sense. They're in the consumer staples sector, so they're relatively protected against inflation, and they're in the wholesale business, which would likely benefit from an inflationary scenario. But Costco itself has carried a premium for a long time, so we should really take a look before we make any decision. Let's go. Welcome back, you brilliant 17,000 subscribers. This is going to be a little bit more off the cuff versus my usual videos, and it's because I want to be able to create more content for you. So if you appreciate this, if you find this valuable, you can take some time to figure that out first. But if you do, please take some time to hit the like button. Let me know in the comments, subscribe, let the algorithm know that you like it. And if it ends up being one of my top performing over the next couple days, then I will crank out another one for you before Friday, another value-filled piece of content, hopefully. But I've been looking at Costco because I do get asked a lot by clients and by viewers alike whether or not it would be a good inflation hedge, like I said in the introduction. And recently they've had a massive sell-off along with many other similar names that sell retail goods. And so maybe this is a good time to enter. But I wanted to answer that question for you guys, for my clients. So I wanted to show you what I've been looking at. And I have to say that I am a practicing professional. So this is not investment advice. I don't know your situation uniquely. I don't know if what I'm about to say as far as specific valuation or whether or not it would make sense for me and my clients, whether it would make sense for you. I'm not going to be able to say whether it makes sense for you. So if you have any questions about that, definitely check out my disclaimer. The links are in the description. And in general on this channel, I try not to talk about stocks that we actually hold at this point, but just stocks that I'm thoroughly looking into. So even before I've made that decision, even if we end up holding it at some point in the future, when I'm covering it on the channel, I tend to not have a position yet myself. So keep that in mind. But that makes it easier from a compliance perspective. All right, so let's dive in. I have this chart here pulled up on TradingView with so if we look year to date where how Costco has performed compared to the consumer staples sector, so the XLP, which is an ETF that follows the consumer staples sector and index. And you can see that the whole sector has fallen, but not by near as much as companies like Costco, Walmart, Target. Those companies have been hit significantly recently, much more even than the SPY, which is following the S&P 500 index. And you can see a lot of this sell-off here with these red bars, the negative trading volume that happened with Costco happened around the time that Target had its earnings. And they were below expectations, and same with Walmart's, and they blamed inflation. Their margins were being cut into. Now Costco already has really tight margins. They're kind of known for paying their employees really well and then passing as much of the savings that they're able to negotiate onto their consumers. So they're already operating with tighter margins. So they have a different business model a little bit than those competitors, especially than Target. So we'll see when they have earnings tomorrow how this inflationary crisis is actually affecting them. But that's the landscape today, how Costco, from a price perspective is faring compared to the S&P 500 and compared to the rest of their sector. And if you pull it out over a year, you can see that it's been kind of all over the place. It has much more volatility than the rest of its sector. But if you go out over 5 years, it's been a standout holding if anybody has had it. And we can see that whenever we look at Costco as a company. So I pulled up Costco here on Simply Wall Street, and you can check out the link in the description for my affiliate link to Simply Wall Street, which will get you an extended free trial. So check that out. It's my favorite place to go just for a quick glance at how a company is performing, so I can get a full picture to decide if I want to dive any deeper. And so immediately you can see why it's performed well, because in the past they've tended to outperform the rest of the industry and consistently put up good numbers, and they have a really healthy balance sheet. And what that means is, so it says here, outstanding track record with a flawless balance sheet. They have good management that has been able to put them on this path in the past. And whenever we get down to management, and we'll jump down there in a second, but you can see that the same management is at the helm. And so that's promising going forward. That's a good sign. But when you look at their future projections, it's not really anything impressive. So I guess if they outperform, if they're underestimating what their performance will actually be, then that might end up helping them out. But right now, compared to the rest of the industry, to kind of starting to level off a little bit from that perspective. And obviously, they're not really, because they've been selling at a premium, because they have such an attractive health and past record, they're shouldn't really be considered a value opportunity. And they do have a dividend, although you might not think it from here, but because they have such a premium, that dividend has been kind of outshined. It's such a small percentage, and we'll see that when we get down there in a second. So I'll jump down to the valuation section here, and that's where you can see a PE score, PE ratio of 35.2, which feels like a lot. That's higher than what Google was trading at whenever we looked at Google a couple weeks ago. And so, it's like I said, it's trading at a tech valuation. As to whether or not it deserves that, we'll have to see. But compared to its industry, the industry is much closer to 20, and the market is much closer to 15. And we'll come back to those numbers whenever we're trying to figure out a terminal multiple for the valuation part at the end. But even from if you add in growth, that's one reason that could justify a higher PE today if they have high expectations of growth. But as we said, their expectations of growth don't seem to be that high relative to the industry, so they don't have a great PEG ratio either. And then their price to book value is pretty insane compared to the rest of the industry. So pretty much from every angle that you look at it from a valuation perspective, it seems rather overvalued. We can even jump over to SeekingAlpha, which is going to go into even more detail, and they break down on several different factors how they would, based on their algorithmic comparisons to all the other companies in their industry, how it stacks up. And yet, from a valuation perspective, in this industry, price to sales or EV to sales isn't quite as relevant. That's more of a tech not profiting type measure. But all the ones that matter here really for this sector, they're relatively overvalued compared to their peers. Now again, that doesn't mean that it's not justified, but that's what you want to find out as you're doing your valuation. So it's definitely not a value stock right now. Doesn't mean it's a bad holding. It is a stock that the more I've looked into, I would love to hold for the long term. But to improve my margin of safety, I'm always looking to get those type of companies at a value if at all possible. So let's keep looking. If we look at their future growth, like I said, it's much more reasonable compared to the industry. Nothing crazy. If we take revenue off here, we can see that historically they've had pretty consistent earnings growth. We'll look at SeekingAlpha numbers here in a second and see that as well, and that's what they're projecting out into the future. Their free cash flow and cash flow from operations a little bit more all over the place, up and down. So whenever we go to the valuation, because of this, I'm thinking we'll use earnings per share versus free cash flow or price to free cash flow, just because that seems to be a more predictable indicator and stable indicator of what the company's trajectory looks like. But anytime we look at their profitability metrics, so this is looking at future return on equity, but also when we look at their past performance, and we look at, obviously they've done incredibly well, and we look at their returns in the past, and their metrics here, they've been great stewards of capital. They've put them to work, employed it really well, definitely above industry average. And you can see that as well when you come over here to their profitability metrics. Their margins, as I said, are relatively low, and you see that in their rating here compared to the rest of the industry. But their return on total capital, return on assets, return on equity, so their profitability metrics, as far as the return on the money that they have, has outshined the rest of the industry. Again, a justification for having a higher valuation. And again, this is the chart that we looked at. We played around with it for their future growth, but if we looked at past performance here and we take off revenue, we can see earnings per share has been relatively consistent, steady climb, telling a story about how the company performs, what we could expect in the future, or at least a reasonable way to measure it in the future. If we throw on free cash flow here, it's kind of all over the place. So sometimes I like to use free cash flow. That doesn't make sense here, just because it's not going to give us a clean picture. And we'll see that even more when we look at the actual numbers, but it's going to be just so much more chaotic. So we'll stick with earnings. Now, if we jump down to their health, again, the company is responsible. They don't shy away from taking out debt, but they do so in a reasonable way, and I love that you can toggle on cash and equivalents here, so you can see that if we take off the equity, they try to keep their cash and equivalents at least enough to cover all of their long-term debt. But more recently, they've been stockpiling more and more. So, they're prepared for a long winter. They have been responsible and won't be caught off guard by insanely high interest rates, for example, if that were to play out going forward. And the further you dive into their balance sheet, it looks good. It's healthy, and you can see the breakdown here. Now, when it comes to their dividend, that's what I said. They have a relatively low dividend, but again, that's just because the stock price is valued so high that it has such a premium that it makes the percentage from a yield perspective low. And that's just what happens if you get a stock that you think deserves that growth premium. Then you're going to suffer on the dividend side from a return percentage perspective. But that's the reason here that Simply Wall Street doesn't give any check marks to it, even though I think it probably deserves some note here, because it just writes it off as not being a notable dividend because it's below the bottom 25% of dividend payers. But what I like about Costco, if I could get it at a good price, is if I take out the yield here, because the yield is affected by the price and the dividend, but if I take out the yield and look at just how consistent they've been over the last 10 years at raising that dividend every single year, and you see more recently there've been even greater jumps, that's a really good stock to hold, especially if you can get it at a good price. So if you can pick it up when it is way undervalued, if it ultimately ends up growing like a growth company, if it has great management, they can maintain that good balance sheet, and they can continue to follow this trajectory this precedent that they've set, that's an excellent company to hold. So really the question is, how is it valued today, right? Can I pick it up at a good enough price to be able to get this what is proven to be, or what looks to be, a fine company? And we'll get to that in a second. Again, you have no question about whether or not they'll be able to keep up paying their dividends. Their payout ratios are great. And this is what I was talking about with management. Average management 10 years. The CEO, Craig's been there for more than 10 years. He's getting older, so at some point he will probably retire. So, that's something to keep in mind. But, this past performance and the financial health are a direct reflection of his leadership. And so that's obviously a good sign that he's still the one that's leading the company. Now, when you look at the breakdown of the leadership team, I would love to see more ownership coming from their leadership team. None of them even hold 0.1% of the company. The closest is the CEO with 0.079% of the company, $153 million worth of shares. But it is good to see that almost all of them have some ownership. I wish it was. I would like to see it more. And then the same thing with the board. You have an experienced board that has been there for more than 10 years, and on the board you'll find one Charles Munger. So that's a lot of people like that he's sitting on this board as well. He's been there for a long time. Again, he's also quite a bit older than the CEO, so that'll change at some point. But nice to see that every member of the board holds some shares, even if none of them even reach 0.1% yet. No, sorry, the average tenure of the board is 12 years, so even longer than the rest of the management team. Now, the one thing that's concerning to me is this: when you look at the breakdown of insider buying and selling, insiders have been selling pretty consistently, and honestly, the stock has been really, it was one of those stocks that really took off recently. It's been what I would say overvalued. I mean, I've looked at it a couple times over the past several years. It's been pretty overvalued. I don't even necessarily want to say overvalued. It's been really highly valued, and that might explain why a lot of people are selling out. Now, insider selling is not necessarily a sign that it's a bad stock, or anything or even that it's overvalued. You never know why somebody might be selling, but it is worth keeping an eye on when there are a lot of different people selling and they're doing so consistently. That's not a great sign. Now, buying almost always is a good sign, right? There's no reason, you might sell something because you need to pay for your house or your yacht or whatever, right? But if you're going to buy shares, that's, a direct statement that I think this is worth me putting my $500,000 here. So that's a good sign, but compared to all the individual sell orders, it's relatively negligible. So a lot of different insiders selling repeatedly over the last year, probably even longer than that. And you can see, the individual stock price at the time was high. Almost all of these were higher from here on, was higher than where it is today. So, maybe that was just them acknowledging that this is a really high valuation for my shares. Or they're all old, as we observed, and they're just in retirement, and this is where most of their money is. One of those two things. Anyway, so let's pull together a quick stock analysis for Costco, just to see. And again, this is a kind of a quick hit analysis. We could definitely go into more detail, and if you're interested in that, let me know, and we can look at some of the more nuanced aspects of Costco. But just from looking at the numbers, I want to see if it's worth diving deeper into today, right? There are thousands, tens of thousands of stocks that are out there, so I have to do this with a lot of companies. And again, if you're okay with that, and you find value in seeing this kind of quick, dirty process, then I would love to share more with you. So let me know in the comments. So I pulled these numbers over real quick just so I could have my own ability to manipulate them, as you've seen in some of the deep dives that we've done in the past. I've pulled them from SeekingAlpha. You can get them from other places, but like I said, like I told you in the past, I just like to copy and paste them from here into my sheets so that I can do my own calculations on what the return has been. So I pulled revenue, net income, diluted EPS. So those are on the same vein on the income statement. And then I also went over and pulled leveraged free cash flow from the cash flow statement, which, as we saw, is all over the place. So I was able to quickly determine that is not going to be a good measure for what's a predictable rate of return for the company going forward. I'm not going to use 100% growth rate there. But you can see why. It's because they've had just ridiculous downsides, and then if you look at 2015 to 2017, it's a reasonable growth rate. But when you're taking the averages of the percentages, it's not particularly helpful because it hasn't been stable. So pay attention to that. So anyway, as we talked about already, EPS is what I'm gonna use. I'm gonna look at PE ratio. I'm gonna use the diluted EPS growth rate. And so when I look at that compared to net income, they've been similar, right around 12-13%. And you can look at the historical growth, and it's been pretty consistent. There are some years that are around 0%. Other than that, they've all been positive. The worst has been 9%, and then 14%, and everything else has been above 15%. And they really benefited last year from probably from inflation scares, where more and more people were going to buy wholesale. And honestly, if the inflation concerns continue, now people have stocked up on stuff. I think that those inflation concerns will be more likely to hurt stores like Target and maybe Walmart, those type of stores, because if they still have inflation concerns, as they start to run out of the things that they just stockpiled, they're going back to Costco and Sam's Club, also owned by Walmart, to stock up again. Now, if inflation concerns dissipate, they may still go back because now it's fresh in people's minds. You had your grandparents who had the Great Depression fresh in their mind, and so they always had that stockpile, emergency fund, rainy day mentality where they would stockpile food and essentials that they needed around the house. But younger generations didn't. And now that might change now that this fresh inflation threat has been implemented into people's minds. So maybe you see that as a continuous boost to these wholesale type companies, but probably not a 25% growth like they saw in 2021, but maybe back down to something that's more normal, maybe like 12 or 13%. I also pulled over their shares outstanding because I always want to know how much they're diluting their shareholders, because that's going to make a difference when I look at any sort of ratio that's on a per share basis, like price to earnings ratio. So I have to be careful there. I have to be aware. Also, if I'm a shareholder, I want to know if they're massively diluting me or if they're buying up shares, because if they're reducing the number of shares outstanding, which they do occasionally, that's to my benefit. If they're adding shares, like with their stock-based compensation, which they do, as many companies do, I want to be aware of that as well. It's nothing crazy. Even recently, it's always been a manageable number one way or the other, which is fine compared to the amount that they've been growing. And I dug through their records and pulled out historical share prices from each of these reporting times. so that I could see what a historical PE ratio was for the company, because I want to find an average. I want to find what's reasonable, and I want to use this data to help me determine what my terminal multiple is going to be in the future. So when I'm doing my valuations, I usually look out 7 years. That seems like a reasonable amount to, if I hold this stock for 7 years, where is it going to be in that time? Nobody knows exactly, but 10 years just feels like a really long time for me, and 5 years doesn't feel like enough. So you can use whatever amount makes the most sense for you. But that's what I'm looking for here with the PE ratio is what kind of multiple has this stock commanded in the past, and then I have to project that out into the future and think, what should I expect it to carry in the future. So on average, over the last 10 years, it's had a PE ratio of around 28. That's the multiple. And you can see more recently, it's been well over that. And this is the time that we saw all that insider selling, and that was my suspicion there. But if you look at the trailing 12 months, so where it is now, as it had that massive decline, it's still sitting at greater than 34. That's a really high multiple. Like I said, when we looked at Simply Wall Street, I think it was showing 35. So that's really high, especially even compared to its own past, and especially compared to the industry. So let's pop over to the U.S. consumer staples industry. This is back on Simply Wall Street under their markets tab, where I looked at the staples market. So this consists of 402 companies. But if we look over the last year, the average here was 22.4. Can't ever get my mouse on it, but if you look over the last 3 years, it was 21.2. If you look over the last 5 years, it's 20. And if we look over the last 10 years, it's 20. So you can see this industry has been pretty consistent, that an average valuation for the industry is 20. So that's good to know. Obviously, again, Costco has carried a premium valuation since almost 10 years ago. It's been moving higher and higher on that front, and now it's maybe starting to come down. But anyway, so if we plug in those growth rates, let's say that I use a 10% discount just because that's at the bare minimum what I want to realize from my investments. It's what I know I can get in other areas. So that's kind of my baseline, and then everything that might show up as undervalued here is that additional margin of safety that I'm looking for, and then I can compare my stocks on a side-to-side basis. Yeah. So if I look at a growth rate over the next 7 years, an average growth rate that I think would be kind of a base case, what I expect to happen, I'm going to go with just the low end of what's been happening in the past. I think over the next couple of years, they'll have some hard comps to beat, and so they will have some lower percentage returns, but they have great management. They have a great track record. I think there's no reason at this point. I mean, they continue to grow pretty steadily. I've looked at their expansion into other countries, and it's been pretty consistent across the board. Their memberships continue to go up across the board. They have a pretty steady growth trajectory. So I don't think at this point, there's any reason to believe that they're going to start coming down yet. And I think over the next 7 years, they could sustain a similar, maybe slightly lower growth rate. So that's why I'm putting 12% here. I went 3% in either direction for my bull case and my bear case. I don't think you're going to see extremes here. So that's another nice thing about this stock, is that in my view, it's going to be relatively predictable. If they really show out and stand out and continue to innovate and expand more aggressively than I've been expecting, but also not uncharacteristic of these last several years. They've had an average growth rate over the last 5 years that is greater than this, then 15% I don't think is unreasonable. So that's for a bull case scenario. So that's what I'm putting there. And then I put 9% on the low end, which is historically lower than what they've done over any period. But if you think of a company that's, law of large numbers, reaching more of their terminal velocity, and they just inevitably have to slow down because they already have so much exposure. So anyway, that's what I'm looking at there. And then from the terminal multiples perspective, so what's the PE ratio that it's going to be commanding at that point. So 7 years into the future, it's an older company, it's expanded a lot more. At some point, the company matures and starts to come down. So even though it's been commanding a PE ratio north of 30, touched over 40, and it's still around the mid 30s, I don't think even in my bull case scenario that from as a value investor, as you know, somebody who wants to be conservative, who wants to build on margin safety, even my bull case scenario is going to have a lower number than that. So I went slightly over, for my base case, slightly over the industry, because I do think it's a solid company. I do think it deserves a multiple higher than the industry average, which, as we just looked at, was around 20 across the board. You know, no matter what time period we looked at, the shorter time periods were around 22. So I gave them a 22 multiple there. And then for the bull case, I went slightly under where their average is today. So they're averaging just under 28 today. And I think the recent past has been a really euphoric state for the market. And so, you know, I do want to discount those recent numbers kind of out of that average. And so I brought it down a couple points, down to 26. And I think that would be a bullish valuation for the stock in 7 years from now. You know, they've grown by 15% per year, but surely at that point they're starting to show some signs of age, some signs of slowed growth on the horizon. And so that starts to get priced into the multiple, and it starts to come down. And then on the bear case scenario, I just, you know, since I went 4 up, I went 4 down on the other side. So this is slightly below the industry average. Maybe the whole industry slides down a little bit if we slip into a recession at some point over the next 7 years, which surely we will. But like I said, when we looked over the last 10 years, the average has been around 20. So this would put it slightly below, you know, maybe some of the younger, smaller companies that are able to grow a little bit faster, and at that point, 7 years from now, can command a higher multiple. All right, with all of those numbers plugged in, I pulled over this 12.41 diluted EPS number over to the chart right here. And I pulled this in yesterday, but this price is pulling today, so that gives us these values. So it's populated all of this. So this is having the earnings per share grow by this growth rate every year, and then we assign the terminal multiple in the 7th year, and then we discount that back to today. You know, so over those 7 years, what that's worth to us at that 10% discount rate. So at a base case scenario, that's quite a bit lower than what it is today. You know, obviously, yeah, I would love to own this company, but I would love to own it at a good price with a healthy margin of safety built in. So this gives me an idea of what price, you know, as it sits on my watch list, what price I'm looking for to start entering some put option contracts, to start selling some put option contracts so I can bring in some money, because I know if it hits this price that I'm going to buy shares anyway. But yeah, you can look at the rest of the breakdown here where, you know, at the bull case scenario, that comes back to about where it is today. And I think that's how it's being priced today. And that makes sense to me. I mean, it has a high multiple. It's like they're expecting a lot of growth, and they're expecting it to have a relatively high terminal multiple 7 years from now still. And maybe it does. But I think in my mind, that's more of a bull case scenario versus what I think is the most likely outcome. I could absolutely be wrong. Again, there are tens of thousands of stocks out there. I'm not going to interpret all of them exactly right. I try to do all of my interpretation, though, on the conservative side. So if I'm not sure I understand something, I try to lean on the conservative side so that I'm never too disappointed. That means I definitely will miss out on some upside opportunities, and I'm okay with that. And real quick, some of you may have already noticed this, but I realized as I was editing that I was missing the dividends. So I went ahead and threw those together for you. I wanted to plug this in. Thought about just putting it in the comment, but I was like, no, need to record it and go through the effort of adding it into the video. So hopefully you appreciate that. So I pulled over their annualized dividends. So this is, you know, how much they paid out annualized from what their dividend was in January of 2012. And since they have a consistent, you know, steady dividend increase, it makes sense to do it that way. I pulled it out every year through, this is actually 2022's number. So I looked at their annualized return, the annualized increase of that dividend from year to year. And the average over the last 10 years has been a little under 13%, 12.67%. And that's been pretty consistent. It's not exactly that, but somewhere between 7.69% was their lowest and 14.04% or 14.58%. So good, healthy increases every single year. So I want to incorporate those into our model. So I projected out their dividends. So this, what it'll be for if I bought into the stock today and then out into 7 years from now. And this is just applying that 12.41 7.6% growth every single year. So this is what the annualized dividends would be if that's the same amount that they grow it each year going forward. And so then if I discount each of those payments back to today, so I'm still using that 10% discount rate, so it doesn't really add that much difference each year because they're increasing their dividend by 12.67%, but I'm discounting it back to today at a rate of 10%. So it's very, very close to the dividend that they're paying today and what that looks like. But I do want to add all those payments back to today because I will get paid that along the way. I'm getting paid $3.24, effectively at today's discount rate, or at that 10% discount rate, and $3.74 what it's worth to me today 7 years from now. So I want to factor those back in because I'll get paid those and I'll still own the share of stock. I'll still be able to sell that stock in the future. So again, that does affect the price. Before we were looking at 309. Actually, it was different because this is connected to Google Finance, so it updates regularly. It is a higher price now than when I was recording just a couple hours ago. But anyway, what would have been a $309.72 valuation today at that base case scenario is now $334.10. So it did change things, and it is worth keeping in mind and paying attention to. And if they announce a dividend increase this coming earnings call, which I think that they will, it'd be interesting to see how that plays in with the increases in the past. Anyway, let's get back to the end of the video. Let me know what you think here. Am I missing something big? Let's talk about it in the comments. And then again, let me know if you want to see more of these. I can crank them out faster. They're not as polished. I do apologize for that. I like my videos to be polished. And on that note, if you haven't seen my deep dives, you should definitely check those out. Those are much more polished and they go into even more detail than we went into in this video. So check them out. I know you'll get value from them. I look forward to seeing you there. Wish you all the best. Take care.